Welcome back to Investing Talk Podcast.
Today we're looking at Rocket Lab.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. And really the core story here, it's all about hypergrowth.
Right.
And, rapidly improving financials. It just completely challenges that old idea that all space companies are these speculative long shots.
Yeah, they are really executing. And 2025 feels like the year that proves it.
It absolutely is. I mean, the financials alone tell a pretty compelling story of scale. If you just look at Q3 2025, revenue hit a record $155.1 million.
And that's a 48% increase year over year?
8%, exactly.
That is just huge, especially for a company that's dealing with complex hardware and manufacturing, not just, a software model where scaling can be easier.
Not at all. And their forward guidance suggests this pace isn't slowing down. Full year 2025 revenue is projected to be really strong, somewhere between $720 and $740 million. And analyst models are suggesting they could hit around $909 million in 2026. That's another 40+% jump.
Okay, but here's where it gets really interesting for me, and I think for anyone tracking profitability. The margin expansion.
Yes.
Usually when a company grows that fast, they sacrifice margins. But Rocket Lab seems to be doing both at the same time.
They are. Their GAAP gross margins, and that's the standard measure, hit an all-time high of 37% in Q3.
37%. For building rockets and satellites. That tells me some serious operational leverage is kicking in. But where is that coming from specifically?
It's largely being driven by the space systems segment.
Ah, okay.
That's the business of selling the satellite buses, the crucial components like reaction wheels, all the mission services. It contributes the bulk of their gross profit.
So launch is the flashy part, but space systems is what's really paying the bills and driving the profitability.
It's the engine, exactly. It provides the economic cushioning.
So they aren't profitable yet, but this makes it feel like they're on a much clearer path than some of their peers.
A much clearer path. We saw the net loss narrow quite a bit in Q3. The EPS loss was only about 3 cents, which was much better than what the consensus was forecasting.
And that kind of small beat can signal to the market that things are moving faster than expected.
Right, that the operating leverage is really kicking in.
And this is all supported by, a pretty resilient balance sheet. Last I checked, they had over $1 billion in cash and equivalents.
Which is an essential runway in a high CapEx business like this. That liquidity gives them immense flexibility. And then you have the backlog underpinning it all.
The $1.1 billion order backlog.
Yes, and the critical part for visibility is that more than half of that is expected to turn into revenue within the next 12 months. That's huge.
But the real proof point for me, the one that I think gets buried in the headlines, is about the cash flow.
Oh, absolutely. For the first 9 months of 2025, their operating cash flow was actually positive.
Positive, right.
$48 million. And think about that for a second. They're pouring all this money into R&D for the Neutron rocket, but their day-to-day operations are already generating cash.
So the space systems business is so robust, it's essentially paying for the development of the next generation launch business.
You got it. It's an internal funding engine. Most of their competitors have to rely purely on outside capital for that kind of R&D. It's a massive differentiator.
Okay, so that financial flexibility lets them sharpen their competitive edge.
Yeah.
So what is that edge? Why do people call them the second source to SpaceX? What's their moat?
The moat is vertical integration. I mean, they've executed it brilliantly.
So they're not just selling a ride to orbit.
No, not at all. They're an end-to-end provider. They combine the launch vehicles, the Electron, with the space system side. So they offer the satellite bus, the components, the mission services, the whole package.
It's the classic selling the shovels and digging the mines strategy.
Precisely. It makes the customer's life so much easier. You sign one contract with one partner who handles the whole life cycle. It creates a very sticky relationship.
And they've been buying up companies to strengthen that, right? Like the Geost acquisition for, almost $290 million?
Yeah, and that was a very specific, targeted buy. It was all about bolstering their national security and government sensor capabilities.
So getting the tech in-house to win those bigger, higher-margin government contracts.
Exactly. And we see other validation of their component expertise, too. They just got a grant from the Canadian Space Agency for a new reaction wheel. It shows confidence in their engineering.
And speaking of engineering, the Electron rocket is still the workhorse, and their execution there has been just exceptional.
The reliability and the cadence are what builds that trust. They did 19 launches in 2025, which already surpassed the 16 they did in all of 2024.
The constant successful cadence is really the bedrock of their whole reputation.
It is.
But if Electron is the workhorse, then the future value really is all about the neutron rocket.
That's the big one. It's the reusable medium-lift rocket that's designed for those LEO mega constellation deployments.
Things that are way too big for Electron.
Right, and they just hit a key milestone there with that unique fairing.
A hungry hippo fairing.
That's the one. The fairing is what protects the payload, and Neutron's is unique because it doesn't just fall away. It stays attached and hinges open, then closes again before the stage lands.
Which is all about rapid turnaround. It makes reusability so much simpler.
It's core to the architecture, and sending that qualified flight hardware to the launch site in Virginia well ahead of their Q1 2026 first launch target, that shows the progress is real.
So the fundamentals are accelerating, the moat is getting deeper, and they're hitting their milestones. How is the market actually, reacting to all this on the charts?
The reaction has been very positive and sustained. The stock is in a strong medium to long-term uptrend.
So it's above the key moving averages.
Comfortably above both the 50-day and the 200-day. It's a classic bullish configuration that suggests institutions are accumulating shares.
And the whole sector has a tailwind right now.
Immensely. I mean, you hear this chatter about the massive private valuations for peers like SpaceX, and investors get FOMO. That money rotates into the public companies that are actually executing.
And Rocket Lab is basically the prime candidate for that rotation.
For now, yes.
Let's talk about who is actually buying, though. The institutional and insider flows. Institutional ownership is high, right? Around 71%.
It is, and we've seen multiple large funds adding to their positions. But we have to address the elephant in the room here.
The insider selling.
The significant insider selling. It was around $274 million worth of shares sold by the CEO and a director over 3 months.
On the surface, that sounds pretty bad.
It does, but you need the context. The stock was up over 100% year to date. So this is generally seen as just portfolio diversification after a massive rally.
And that story is backed up by the fact that the CEO himself went and bought shares on the open market, right?
Yes. He made an open market purchase of $2.1 million in October. So he's selling high to diversify, but he's also buying on a dip because he clearly believes it's still undervalued. That's a huge signal of conviction.
Okay, so looking ahead then, what are the immediate catalysts we should be watching for over the next, say, 3 to 6 months?
Well, the Q4 earnings release in February is going to be critical. They guided revenue between $170 and $180 million. Hitting the high end of that and showing continued margin expansion is essential.
And operationally.
Just more of the same, really. Successful completion of their year-end missions, like the CASE and JAX-A launches. And, of course, any positive updates on Neutron.
Engine testing, pad readiness, that sort of thing.
Exactly. Every positive update on Neutron shrinks the risk premium on the stock.
And what about the unconfirmed buzz? The speculative stuff that could really move the needle if it turns out to be true?
There are a few things. First, there's always chatter about a potential large multi-launch contract for national security. Securing one of those would be a game changer.
That would really solidify that second source to SpaceX idea.
It would. Second, there's speculation about a strategic partnership with a major cloud provider. Not just a contract, but a real partnership to expand satellite data services.
So they'd move from just being a hardware supplier to an infrastructure enabler.
Precisely. And finally, there are always rumors about an accelerated timeline for Neutron. The official target is Q1 2026, but any hint that they're ahead of schedule would be a massive upside surprise.
Okay, let's bring it back down to earth a bit. We need some prudence here. What are the big risks? What's the bear case?
The number one risk is just execution on Neutron. The whole long-term valuation depends on that rocket becoming operational and reusable. Delays, cost overruns, that would hit the stock hard.
And they are still burning cash, even with $1 billion in the bank.
That's the second risk, the financial risk. They have negative operating margins, negative free cash flow. They have to manage that cash really well to get to the finish line with the Neutron.
And finally, I guess, just the inherent risk of the business itself.
Of course. Launch risk. This is a high beta sector. A launch failure is, unfortunately, inevitable in this industry, and it always causes a sharp stock pullback.
But you'd argue the $1 billion in cash and the diversified revenue from space systems provides a pretty decent buffer against those risks.
It provides a material buffer, yes.
So if we connect all these dots, 2025 was really the year they proved they could transition from a promising startup to a scaled, integrated platform.
That's the big picture. It was the year of real operational execution and margin inflection.
So what does this all mean for you? It raises an important question you should be mulling over. In the rapidly expanding space economy, how much value should be assigned today to a vertically integrated company that can execute at scale and internally fund its next generation of technology, compared to those players still relying purely on venture capital and focusing only on R&D? That level of execution changes the risk profile entirely. Don't forget to subscribe to the podcast to keep getting the most important analysis right to your ears. Thank you for joining us.